Let's get right to it. We're diving into a critical tool that every trader, whether novice or experienced, needs to understand. This isn't just about making profits, it's about protecting what you already have. So what is a stop loss? Think of it as a seatbelt for your money. It's your primary defense against unexpected market downturns. It's a preset order that tells your broker to sell if a stock drops to a certain price. This predetermined price acts as your line in the sand, preventing further losses. You don't expect a crash, but if you do, and the market can be just as unforgiving as a high-speed collision, you want to limit the damage. A stop-loss order automatically kicks in, selling your position to prevent catastrophic losses. The market is unpredictable. It's a complex beast influenced by countless factors, many of which are beyond our control. One bad move can wipe out your capital if you're not protected. Without a safety net, a single misjudgment or unexpected event can decimate your trading account. Without a stop loss, you're exposed to huge losses, essentially gambling with your entire investment, hoping things turn around as your account drains. This is a dangerous game of hope, not a sound trading strategy. A stop loss removes emotion, a critical element in successful trading. Fear and greed can cloud judgment, leading to poor decisions, enforcing logic and discipline. It forces you to think rationally about risk before entering a trade. For example, with a $10,000 account, let's illustrate how a stop loss can protect your capital. Risking 2% per trade means your max loss is $200. This is a manageable loss that won't cripple your account. This keeps you in the game, allowing you to learn from your mistakes and continue trading, even after a string of losses. Small controlled losses are far better than one catastrophic blow-up. Professionals always define their risk and accept small losses. It's part of the business. They survive to trade another day. Longevity in the market is key to long-term success. Embracing stop losses is the first step to trading like a pro. It's about managing risk, not just chasing profits. It's the most important habit you'll ever build. Master the stop loss, and you'll significantly increase your chances of long-term success in the trading world. In the world of trading, risk management is paramount. One of the most fundamental tools for managing risk is the stop-loss order. But what happens if you skip the stop-loss? What are the potential consequences of trading without this crucial safety net? You fall into the trap of hopium. This is where emotions override logic, and you hold on to losing positions, hoping they'll eventually turn around. It's a dangerous game to play with your hard-earned capital. You buy, feeling confident in your analysis, but almost immediately, it drops. The market doesn't care about your feelings or your analysis, and you hope it'll bounce back. You tell yourself it's just a temporary dip, a minor setback. You convince yourself to hold on, waiting for the inevitable rebound. But hope isn't a strategy. It's not a reliable foundation for making sound financial decisions. The market can remain irrational longer than you can remain solvent. The math of losses is brutal. It's not linear, it's exponential. The deeper you fall into the red, the harder it becomes to climb back out. Lose 25%, you need a 33% gain just to break even. That's because the gain has to be calculated on a smaller base. Lose 50% and you need to double your money to recover. That's a 100% return, a feat that's difficult to achieve in any market condition. Imagine buying 100 shares at $50, a common scenario for many traders. You see an opportunity and decide to invest, no stop loss. You decide to forego this essential risk management tool, perhaps feeling overly confident or simply negligent. Bad news hits, price drops to $30. A negative earnings report, a market correction, or some other unforeseen event triggers a sharp decline. You're down $2,000. A significant loss, but you're still holding on, hoping for a turnaround. You hold, hoping for a rebound. You tell yourself it's just a matter of time before the stock recovers, but it falls to $20. The situation worsens, and the stock continues its downward spiral. Now you're down 60%. Your initial investment has been decimated, and the losses are mounting. To get back to even, the stock must rise 150%. A monumental task requiring a significant and unlikely surge in price. Unlikely. The odds are stacked against you, and the chances of a full recovery are slim. With a stop loss at $47, your loss is capped at $300, not $3,000. A much more manageable loss that you can recover from. You keep most of your capital for the next opportunity. You live to trade another day, armed with valuable lessons learned. The difference? What separates the successful trader from the one who blows up their account? One trader takes a small cut, accepting a calculated loss, the other risks a fatal wound, potentially wiping out a significant portion of their capital. Stop losses are the line between survival and disaster. They are your insurance policy in the unpredictable world of trading. Don't trade without a net. It's a reckless gamble that can have devastating consequences. Protect your capital first. It's the most valuable asset you have as a trader. Without it, you're out of the game. The choice is clear. Use stop losses, manage your risk, and increase your chances of long-term success in the market. There are two main ways to set a stop loss: percentage-based and structure-based. The percentage method is simple. Risk a fixed percent, like 5%, on every trade. It's easy, but ignores how the stock actually moves. The structure-based method uses the chart, placing stops just below support levels where buyers have stepped in before. This aligns your risk with real market behavior, not arbitrary numbers. For example, if a stock bounces off $45 repeatedly, that's your support. Buy at $47, set your stop just below $45. This method requires some chart reading, but it's a skill every trader needs. Percentage stops are simple, but structure-based stops are smarter. Learn to read the chart, it's worth it. Let's compare the two methods with a real example. You buy Tech Giant Inc. at $155. Trader A uses a 3% stop loss, setting it at $150.35. Trader B checks the chart and sees strong support at $149, so sets the stop at $148.75. The stock dips to $150.50 on minor news. Trader A's stop is triggered, they're out with a loss. Trader B's stop holds. The stock never touches $149. The price rebounds and closes at $158. Trader B is still in, now profitable. Trader A missed out because their stop was too tight and ignored the chart. Structure-based stops keep you in good trades and out of bad ones. Don't let random noise kick you out. Let the chart guide your exit. Smart stops make all the difference. Here's how to set a structure-based stop loss, a technique that aligns your risk management with the actual price action of the market. It's a method that moves beyond arbitrary stop-loss placements and grounds your decisions in tangible support levels. This approach not only protects your capital but also increases the probability of your trades playing out as anticipated. Step by step, we'll break down the process into manageable steps, ensuring you understand each component before moving on to the next. This systematic approach will empower you to implement structure-based stop losses effectively in your own trading strategy. First, identify the trend and your entry point, the foundation of any successful trade. Determining the prevailing trend is crucial because it sets the directional bias for your strategy. Look for opportunities to align your entries with the established trend, increasing the likelihood of a favorable outcome. Look for a stock in an uptrend pulling back to value. This pullback represents a potential buying opportunity, allowing you to enter the market at a more favorable price. It's a chance to capitalize on temporary price weakness within a broader bullish trend. Next, find the most recent, obvious support level, a price area where buyers have historically stepped in to prevent further declines. Identifying these levels is key to placing your stop loss in a strategic location where the price has bounced before. These bounces indicate a concentration of buying interest and validate the significance of the support level. The more bounces, the stronger the support. A support level that has been tested multiple times is generally considered more reliable and robust. Place your stop just below this level, not right on it. This is a critical aspect of structure-based stop-loss placement. Give it some breathing room to avoid stop hunts. Stop hunts are instances where the price briefly dips below a support level, triggering stop-loss orders before reversing and continuing in the intended direction. How much room? Depends on volatility, which reflects the degree of price fluctuations in the market. Higher volatility necessitates a wider buffer to accommodate larger price swings, but usually a small buffer below support. This buffer acts as a safety net, protecting your position from temporary price fluctuations, while still adhering to the principles of structure-based risk management. Now, calculate your position size, the number of shares or contracts you will trade. This calculation is essential for managing your overall risk exposure, so your total risk matches your plan, say, 1% of your account. This rule ensures that you never risk more than a predetermined percentage of your trading capital on any single trade. For example, if your entry is $52, support is $50, providing a clear reference point for your stop loss placement, and your stop is $49.75. Your risk per share is $2.25. This represents the potential loss per share if the price reaches your stop-loss level. Willing to risk $100? Buy 44 shares. This calculation ensures that your potential loss remains within your predetermined risk tolerance. This way, your risk is always controlled, regardless of market fluctuations or unexpected events, no matter where your stop is. This consistent approach to risk management is crucial for long-term success in trading. Structure-based stops connect your risk to the market's reality. They are not arbitrary guesses but rather informed decisions based on observable price behavior. It's a disciplined, logical approach. This method removes emotional biases from your trading decisions, promoting objectivity and consistency. Don't guess, let the chart decide. The chart provides valuable information about price levels, trends, and potential support and resistance areas. This method keeps you safe and in control. By implementing structure-based stop losses, you can navigate the market with greater confidence and reduce the likelihood of significant losses. Master it, and you'll trade like a pro. Consistent application of this technique will refine your trading skills and elevate your performance to a professional level. Structure-based stops aren't just theory. They work in real markets. Take Momentum Motors. It rallies to $120, pulls back to $110, rallies to $130, then back to $110. $110 is proven support. Buy at $112, set your stop just below $110. The stock dips to $110.25 during a market sell-off, but your stop holds. It rebounds and continues higher. A percentage stop would have kicked you out early. Structure-based stops keep you in winning trades and out of random noise. Only exit when a key level truly breaks. That's real protection. Even with a good plan, mistakes can cost you. Don't move your stop further away when a trade goes against you. That's gambling, not discipline. Avoid setting stops too tight. You'll get stopped out by normal price noise. Don't play stops at obvious round numbers. Big players hunt those levels. Always put your stop just below real support, not at a predictable spot. Don't get angry when your stop is hit. It's doing its job. A triggered stop is a win for your discipline, not a failure. Every small, planned loss is a victory for your capital. Respect your stop loss like a seatbelt. It's there to save you. Learn from each stop and improve. Setting a stop loss is only half the battle. The rest is mental. Focus on following your process, not the outcome of one trade. Set your stop, walk away, and let it work. Don't obsess over every price tick. Trust your plan. Losses are normal. Think of them as the cost of doing business. Accepting this removes the emotional sting. Start small. Risk amounts you don't care about to build discipline. Practice honoring your stop loss until it's second nature. As you see your strategy work, you'll gain confidence. Gradually increase your size as your discipline grows. Calm, consistent execution is your edge. Mastering stop losses is a journey. Make it a non-negotiable rule to never trade without one. Keep a trading journal. Record your entry, stop, and why you chose that level. Review your trades. Did support break or was it just noise? Adjust your stops as you learn some stocks need more room. As you gain experience, you might use tools like ATR to refine your stops, but always build on the foundation of market structure. Consistency and discipline protect your account from disaster. Small, planned losses are your shield. The market will test you. Stick to your rules. Treat your stop loss as your most important tool and you'll trade with skill and confidence.